Hello and welcome to our webinar, sponsored today by ABN AMRO Commercial Finance. My name's Chris Quick. I'm the editor of Accounting and Business magazine here at ACCA. Today's webinar is a topical update for accountants in practice, and we're going to be looking at two important issues. First, we'll be hearing from the Financial Reporting Council with an update on the fundamental changes to UK GAAP. With implementation fast approaching, many of you will now be getting to grips with this. So we hope today's session will serve as a useful refresher and update, and as an introduction for those who've not yet started getting their heads around the changes. We'll also be looking ahead to further changes coming our way as a result of the European Accounting Directive. So I'm delighted to welcome our speaker from the FRC, May Ashelford, a project director in its accounting and reporting team. May has been heavily involved in the development of the new UK GAAP. Before joining the FRC in 2012, she worked in forensic accounting before becoming an exam tutor at Kaplan Financial. So May, a warm welcome and thanks for joining us today.
Hello.
After we've heard from May, we're going to change tack and talk about the increasing opportunity for accountants in practice to help their clients with finance, looking in particular at asset-based finance. And we're delighted to have someone who has frontline experience of this with us today, Mason Bloom, a partner with ACCA firm Silver Levene. Mason qualified as an ACCA member with the firm in 1998. He then spent some time with Ernst & Young in Perth in Western Australia before returning to London and general practice with Silver Levene, where he was made a partner in 2007. He has a large portfolio of clients across legal services, manufacturing, retail, travel and tourism, hospitality and events. Mason, a warm welcome and thanks for joining us today.
Hello.
Now, before I hand over to our speakers, I've got a few housekeeping issues to run through. The presentations are accompanied by slides that automatically change as our speakers present. If you find they aren't progressing, you might want to refresh your browser. For PC users, that's F5, and for Mac users, Command and R. You can send questions or comments at any time using the question area on your screens. May and Mason will do their best to tackle them in a question and answer session after the presentations. The whole webinar will last about an hour. You can enlarge the slide area of your screen by grabbing and dragging the bottom right-hand corner of the slide area window. And you can download the presentation slides as a PDF by clicking the dark green resources button at the bottom of the screen. And there's also a yellow help button if you have problems with the technology. Turning to CPD, if you're an ACCA member, you can count this webinar towards your CPD if it's relevant to your career. You can apply the learning in the workplace and provide evidence you've joined us today. You'll be getting an email you can use as that evidence if you're attending this live. If you're watching the on-demand version, please download a copy of the presentation slides as your evidence. Everyone who registered for this webinar will be getting an email tomorrow with details of how they can listen to it again. It will be available for 3 months. And please feel free to pass these details on to any colleagues or contacts who you think might be interested. So that's it with the introductions and the housekeeping, and it's time to hear from our first speaker. So May, it's over to you.
Thanks, Chris. I'm going to spend the next 20 minutes or so just talking about the new UK GAAP framework. The FRC issued a new regime earlier in 2012-2013, and the objective of today is just to give you an overview of the framework, our most recent projects and developments, and also just looking to the not-too-distant future and the implementation of the EU Accounting Directive. So in terms of the new framework, as it currently stands, we've got 4 standards in issue, which become effective from the 1st of January 2015. So we've got FRS 100, 101, 102 and 103. The way I think about 100 is that it's really a kind of roadmap of where entities can go in terms of their accounting and their reporting. So it kind of sets out, if you're a certain size, what standard you can use. So it's kind of an overriding standard that governs 101, 102 and then 103. I think the most relevant standard for the audience today is going to be 102, which is the one that's going to be applicable to most entities. So I'm going to talk more about 102, but before I do that, I'm just going to give you an overview of how you decide which of the standards your clients can actually use. So at the moment, we've got the FRISI, and that is actually going to be changing in the near future. So when I move on to talk about the accounting directive, I'll actually explain what our plans are that we're proposing in terms of the FRISI. But as it currently stands, we've got a FRISI which is for small entities. We've got FRS 102, we've got FRS 101, and then we've got EU-adopted IFRS. So basically, an entity can always elect to go into a higher and more comprehensive standard. So, for example, if you've got clients that qualify for the FRISI at the moment, they can voluntarily opt to go up into 102 or, for example, into full IFRS if they really wanted to. But I'd expect that most entities will try and stay within the FRISI or into 102 if they wish to start applying IFRS-based accounting. EU-adopted IFRS will be obviously for listed groups in the UK, and then 101 is for specifically for subsidiaries that qualify and parents that qualify as a qualifying entity, where as a group they're more than likely to be applying EU-adopted IFRS. And what 101 does is it basically allows the subsidiaries and parents to apply IFRS in their individual financial reporting statements. But as I said, the standard that's probably the most relevant today is FRS 102. So it's kind of like a catch-all for all of the entities that don't seem to fall into any other category. So moving on to the next slide. In terms of how we developed FRS 102, the project's been long ongoing, should we say. It's been going on for about 10 years. And the decision that was made is that we would move from our current UK regime to a set of standards that are actually based on IFRS. So what we did is we took the IFRS for SMEs that's issued by the ISB, and basically we took it and we've made amendments to make it applicable and relevant for entities that are reporting in the UK and Republic of Ireland. We did spend a number of years doing a lot of consultation and getting feedback before we actually kind of leapt over the cliff, as it were, to make that massive jump, this massive change. But there was a lot of support from the profession and from industry to basically to align with IFRS, as that is where the world of accounting is moving. FRS 102, as I mentioned before, is the most likely standard that will be applicable to most medium and large private entities. So in terms of kind of what's different between current UK GAAP and what you might expect to see in FRS 102 when we come to implementation in January, there are a lot of similarities. So I know there might be feeling that a lot of things are going to change because we're moving to a new regime, but actually the underlying principles are pretty similar to current UK GAAP. But obviously with any new framework there are going to be differences, and it's very important that as practitioners you are aware of where the differences are so that you can advise your clients appropriately. Conveniently, the ACCA have produced a technical fact sheet, which is number 181, which basically sets out the key areas that are different when moving from the current UK regime to FRS 102. I don't have time today to go through every single difference that exists between current UK GAAP and new UK GAAP, but that's definitely a fact sheet that you should try and get hold of, and the link on the slide should actually take you directly to that document. In addition, the FRC have also issued what we're calling staff education notes. There are 15 in total, and they cover the key differences when moving from current to new UK GAAP. So that might also give you some guidance as to the key areas to look out for. Those are also accessible on the FRC website. The most significant difference is going to be financial instruments. So they're going to be brought onto the balance sheet, whereas under current UK GAAP, they're actually predominantly off balance sheet. So that's something definitely that you need to get your head around when advising your clients. Other areas to note, things like intangibles and goodwill, investment properties, leases, employee benefits, cash flow statements and deferred tax. There are slight differences as well in those key areas. So I'd really recommend that you have a look at the fact sheet produced by the ACCA and also the staff education notes produced by the FRC. So in terms of what we've been up to, so we issued the new standards in kind of 2012, 2013, but unfortunately as the standards went out and people started looking at them and trying to prepare for the transition, it's come to our attention that there were a number of issues that were in the standards that actually we needed to address before the standards were implemented. So we've recently completed a number of projects. In July, we issued amendments to both FRS 102 and FRS 101. With respect to 102, it's all to do with financial instruments. One of the key areas of concern that was coming back to us was that the original draft of 102, the place where we draw the line between items that are measured at cost versus where they're measured at fair value, was making it slightly more onerous for UK GAAP companies compared to IFRS appliers. And as a consequence, the profession came back to us and said, we need to look at this urgently, and we responded by basically issuing another exposure draft. And hopefully we've got that line in the sand correct now. So we issued amendments to 102 on basic financial instruments and where you classify between cost and fair value. Also, we've finessed the hedge accounting requirements as a result of the IASB issuing their final standard on hedge accounting. With respect to FRS 101, we actually planned to do an annual review of 101 to make sure that it keeps up to date with developments at the IASB. So we actually issued our first review, the 2013-2014 cycle, which basically just updates it for any reduced disclosures that might be applicable now that the IASB has moved a year into their kind of work program. And we'll continue to review 101 every year going forward. Also, we've issued revised versions of FRS 101 and 102, which we published in August. The reason we've reissued the standards is to kind of compile all of the amendments in one place. So rather than have to refer to the original version plus a set of amendments plus some editorial amendments, we've just thought it would be more user-friendly to actually issue the new standards, the revised editions of the new standards in August 2014. And also we've got an exposure draft out that's to do with pension obligations, which is a very kind of narrow amendment which may not be applicable to you or your clients, but if it is applicable to you, then you may want to have a look at our FRED 55. So those are our recent projects, and the background really was to set up the discussion to talk about what's going to happen in the not too distant future to do with the EU Accounting Directive. So I'm going to run through a bit of the background of this directive, how it's going to impact the financial reporting framework, and what we're proposing to do with micro-entities, small entities, and also any other amendments that might come out of the consultation. So in terms of the background, the legislation, EU legislation, was basically agreed in June 2013, and the legislation has to be implemented by member states by July 2015, so i.e. next summer. The directive also has an effective date for reporting periods from the 1st of January 2016. The document itself is very long and it does contain a significant amount of amendments, but the most significant impact is going to be on the small companies regime. There will be other amendments that are required, and basically what's happening is that the governments, i.e. BIS, are currently consulting on how they're going to implement the EU Accounting Directive into UK company law. And obviously as a result of changes in company law, we at the FRC have to make sure that our accounting standards comply with the law. So we've both issued consultations simultaneously. The BIS consultation, again, is available on their website, and it closes on the 29th of, sorry, that should say, I think it should say September, no, sorry, it should say October 2014, that's a typo in my slides. It's open for 8 weeks, and it's only recently been issued. And then our consultation document is available on our website, and again, it's setting out our proposals for how the accounting framework is going to change as a result of the implementation of the EU Accounting Directive. I'd really, really encourage you all to have a look at the consultations and to actually submit responses to those consultations. We obviously have a lot of contact with the larger firms as our kind of part of our day-to-day business, but we find it more difficult accessing the smaller mid-tier firms. So if you do have clients that you think might be impacted by the changes that we're proposing, I'd really encourage you to actually respond to our consultation documents. So in terms of what's changing, it's actually the two columns on the left that are changing. So what we're proposing is that we will get rid of the FRISI, so the standard that currently exists for small entities we're going to get rid of. And what we're proposing to replace it with is a new standard for micro entities, which I'll talk about in more detail in a second, and that we're going to create a new section within FRS 102 for small entities. And then the rest of the framework will be the same, so we'll still have 102, we'll have 101, and then we'll have EU-adopted IFRS. So the micro regime in more detail, if you're not aware already, the micro regime is actually already in place. So if you do have any clients who are small enough to qualify as micro, so the limits are turnover of 632,000 and I think a balance sheet total of 316. So in theory, they could be applying it already. We have amended the FRISI to accommodate this, but given the kind of changes that we're making to the framework overall, it was a good time now to have a think about how that standard might change so that we can make it more user-friendly and bring it in line with the new regime. Micro entities are a subset of small entities, so these are the smallest entities in the UK. There are certain specific qualifying conditions before you can qualify to use the micro regime. So, for example, it only applies to companies. So, for example, if you're a charity, you can't use the micro regime. As I've mentioned before, the turnover limit is 632. Balance sheet total, I think, is 316,000, and number of employees is up to 10. And what the regime basically does, is it basically takes the view that it's minimal disclosure and kind of minimal cost implications. So it's saying because your entity is so small, we're going to limit the amount that the regulators can actually mandate in terms of your disclosures. So the form and the content of the financial statements are actually set out in law, and as regulators we are not allowed to mandate anything over and above what's required by law, and it's presumed that the financial statements are actually giving a true and fair view. In terms of the accounting directive and how it impacts the micros regime, there's actually very limited change that's being proposed. But as I said, it was a good time for us to actually think more about how we might make this more user-friendly. So in our consultation document, we're proposing that we'll create a new standard called the Financial Reporting Standard for Micro Entities. And we have to comply with what will be in the company law. So i.e. the presentation disclosure requirements will be driven by what's in the Companies Act. And we're proposing that the recognition and measurement requirements will be based on the new UK GAAP, which will be based on 102. We are proposing that we simplify certain areas, either as a result of the law or because we think, because these are smaller entities, they don't need to go into this much detail. One of the legal requirements is that micros cannot apply fair value accounting. So they can't, for example, fair value financial instruments. So one of the key areas that we'll simplify in FRS 102 is that financial instruments will be carried at cost or amortised cost only. Things like deferred tax, again, because these entities are so small, we're taking the view that there's probably no need for you to disclose deferred tax and do the complicated calculations. So we're proposing a simplification. So in our proposal document, there are some simplifications that we're suggesting, and it would be really helpful to get your views as to whether you think they are of benefit to micro entities or not, or if there are other areas that you think might be of benefit for us to consider when we're actually finalising the standard. So that's what we're proposing for micro entities. In terms of small entities, so remember, micros are a subset of small. So small entities, BIS are proposing that the threshold for turnover will increase to 10.2 million. So that's increasing from 6.5 million up to 10.2. So we're now looking at quite large entities falling into the small entity regime. Again, the accounting directive limits the disclosures that can be made with respect to the financial statements. So again, the accounting standards need to be amended to reflect the fact that we cannot mandate disclosures over and above what's in company law. The Regulations will also stipulate, for example, that you can only, or you should only present a balance sheet and a profit and loss account. For example, we can't ask for a cash flow statement, we can't ask you to prepare a struggle, etc. So the only financial statements that we require by law will be the balance sheet and P&L account. However, there is a requirement in law that the financial statements give a true and fair view. So although we can't mandate as regulators additional disclosures, there is a requirement for the directors of the companies or the people preparing the financial statements to consider if further disclosures are required to meet the true and fair view requirement in company law. The FRISI, as it currently stands, isn't consistent with the directive because it includes loads of disclosures that we can't mandate. It requires financial statements like the struggle that we can't mandate. So change is necessary, and that's partly why we're having to do the consultation at this stage. So in terms of what we're proposing, we are obviously going to withdraw, well, we're proposing to withdraw the FRISI. We're going to suggest that a new section is inserted into FRS 102 that is just for small entities. One thing just to point out is that it will apply to small entities, not just small companies. So if you are a small charity, for example, this will be applicable to you. We're proposing that the recognition and measurement requirements of FRS 102 are carried over into the small company regime or small entity regime, but the section will basically set out the disclosures and the presentation requirements that will be set out in law. So, for example, we'll say that you can't, well, there's no need for you to present a cash flow statement or a struggle, and that there's no requirement to present consolidated financial statements, but you do need to consider if additional disclosures are required for a true and fair view. So there'll be a new section included into FRS 102. In terms of the differences between what will be FRS 102 for small entities and the FRISI, key differences: financial instruments, again, is a big one. They'll be recognised on balance sheet at fair value. Also, there'll be the possibility of doing hedge accounting. Investment properties, rather than profit and loss, changes in fair value going through the reserves, it's actually going through your profit and loss. There's more deferred tax that needs to be recognised, so on revaluations, for example. There's a need to recognise holiday pay accruals and also need to recognise equity settled share-based payments. In terms of why we're withdrawing the FRISI, and I'm not entirely sure how widely the message has got out that we are proposing to withdraw the FRISI. So if you have a particularly strong opinion on this, we'd love to hear from you. But doing nothing was not an option because the FRISI, as it currently stands, does not comply or will not comply with the EU Accounting Directive. Responses we've had from previous consultations showed support for getting rid of the FRISI and bringing all entities, regardless of size, onto an IFRS-based solution. So that was kind of the key driver. Some of the benefits of doing this is that obviously all entities will be applying accounting standards that are driven from the same basis in terms of recognition and measurement. So as entities grow, they won't be moving from one framework to another that are very different. So there should be minimal costs as entities grow and move through the different frameworks. Key difference obviously is that we're bringing financial instruments onto the balance sheet, which is quite a big difference that you need to be aware of. There'll be cost savings in terms of education and training because everything will be based on the same principles. And also, even if something isn't covered in the FRISI, there's a fallback to FRS 102 anyway, where entities are required to have a look at what the requirements are in FRS 102. So those are kind of the key things. There will be other amendments that we're going to have to propose. There'll be minor changes that will be required to align FRS 100, 101 and 102 with the new company law. We're not proposing a full review of FRS 102. I know we've had calls for us to look at some possible issues in this review, but we're just going to wait. We want to basically create a stable platform as much as we can, and we're going to wait for our first triennial review, which will be taking place in 2016 and 17. Also, we're proposing to insert a new section, Section 34, for residential management companies, which we've already consulted on, but more information on that will follow as we progress through the project. And just to finish off, In terms of what's happening next, the comment period for our consultation closes on the 30th of November, and again, I encourage you to try and respond to the consultation so that we have as much information to develop the correct framework that's going to help the UK economy. We are proposing to, from the responses to the consultation document, to develop exposure drafts and to consult again in 2015 with detailed drafts of what we're proposing to change in the standards. And those changes will be effective from January 2016.
Okay, well, thank you very much, Mai, for that very comprehensive and useful presentation and for painting such a clear picture of the many changes coming our way, including the end of the frizzy. Clearly, as you said, there's a chance for everyone joining us to influence things by responding to the consultation. I'm sure there's lots of food for thought there. Just a reminder to everyone with us today that we'll be having a question and answer session at the end of the webinar, and that you can email your questions to May and to our next speaker using the question area on your screens. In the meantime, we're going to hear from that next speaker, Mason Bloom of Silver Levene. As discussed, we're going to be looking at asset-based finance and how practitioners can advise and help their clients on this issue. But to shake things up a bit, we're going to be running this part of the webinar a bit differently. Rather than giving a presentation, Mason has bravely volunteered to allow us to explore this area by throwing some questions at him. So Mason, let's start at the beginning. Can you tell us a little bit about what form asset-based lending normally takes?
Thanks, Chris. Good afternoon, ladies and gentlemen. Asset-based lending covers a number of different forms of finance for businesses, but intrinsically it is about raising finance based on the assets owned by the business. For many companies, debtor balances are the largest asset in the balance sheet. They may also turn into cash at a much slower rate than the business would like. Typically, asset-based lending would cover invoice financing, whether this is in the form of a confidential invoice discounting facility or factoring. It's effectively an advance payment of eligible invoices issued to customers of the business. Factoring facilities are more appropriate for smaller businesses where there is a lack of a formal credit control function, and the accounting system may not be as robust as us as accountants and asset-based lenders would like to see, really. The asset-based lender manages the whole credit control function, providing a comprehensive collections and credit management service designed to obtain a faster payment from customers without harming goodwill. Generally, factorers will pay up to 90% of outstanding invoices immediately, and the balance when the customers eventually pay. The confidential invoicing discounting is by its nature confidential and would be more appropriate for larger businesses with a more robust credit control function, internal accounting team and credit controller. The business is responsible for collection of its own debts. Either facility may be available on export sales as well as UK sales. Depending on the business and sector, some asset-based lenders will, as I've mentioned previously, will typically advance up to 90% of the outstanding invoice. Usually debts older than 90 days are not financed, and most lenders will offer credit insurance bad debt protection in the situation of defaults. I've found these facilities are extremely useful when businesses wish to speed up their cash flow. Asset-based lenders more recently will also consider lending against other assets on the balance sheet of companies when they are lending alongside an invoice finance facility. Typically, they would look at other assets such as plant and machinery, where they will lend up to 80% of the ex situ value. So if they did need to realise the value of these assets on a disposal, they lend up to 80%. Lenders will also look at businesses carrying stock on the balance sheet, typically lending up to 50% of the book value, and obviously they will make certain reserves for obsolete stock stock must be easily valuable, resaleable, and it also must be easily accessible, controllable, and the stock control system, which is the key point, must be real time. Lenders will look at lending on commercial property owned by the business up to 60% of the market value, and other asset-based lenders may look at unsecured cash flow loans, depending on the debt service capability of the business, also offering bad debt protection as well. Scenarios where more than one strand of this would be utilised in a package of finance would be where companies are looking to acquire other businesses in refinancing or turnaround situations, or potentially for a management team looking to do a management buyout.
Okay, well, thanks, Mason. It sounds like you've built up a good detailed knowledge of these kind of situations. So is this something that's relatively new that you and your colleagues at Silver Levene have got into advising on?
No, Chris, it's not something new. We've been advising on clients on how best to finance their businesses for many years. Personally, I was first involved with raising this type of finance for clients about 15 years ago, so obviously getting a bit old. Aside from providing the normal compliance services that all accountants do, we feel that being able to advise our clients on financing issues and explaining the relative merits of different forms of finance provides our clients with much more timely and valuable advice. I feel that having developed strong relationships with a few asset-based lenders and knowing where to source the different forms of finance for clients is integral to what we do for our clients at Silver Levene. Like most firms of accountants, and I'm sure most of the listeners that are online at the moment, we all have a pretty diverse client base at the practice, with clients ranging in size and operating in various sectors. Having an understanding of when an asset-based lending solution is right for a client's business and identifying that situation, and also when it won't work, is obviously key to being able to advise the clients correctly. I actually believe historically many business owners and potential accountants have had a fairly negative perception of debt factoring and invoice discounting to fund their business, and it was really a source of finance of last resort for businesses where they were significantly struggling with cash flow issues and weren't able to raise finance anywhere else. The presentation slide at the moment really highlights how this perception of the industry has changed, and the growth in the last few years in this type of funding to corporates. My view is, and it's obviously backed up by the data there, that this perception has changed, and accounting professionals, business owners now understand the advantages and flexibility of this type of finance, especially for businesses that require finance for expansion. I don't think clients are actually fully aware of the options available to them, and I believe it's generally a lack of understanding that poses the real challenge. All asset-based lenders will require up-to-date financial information and projections going forward, and will require regular management accounts once the facility has been put in place. The accounting function needs to be able to deal with this, which is where accountants can provide advice and valuable expertise if this needs improving. The level of cost involved with the financing facility and associated terms will generally be of initial concern to most of our clients. So clarity on this from the outset from the asset-based lender should address clients' concerns early on.
Okay, thanks for that, Mason. I mean, just looking at the slides, the slide we've got here looks at how traditional lending to business fall by more than a fifth. But I think we've got another slide which shows how asset-based lending has increased. It's just the slide 23 here. And there you can see the growth of this kind of lending that Mason was referring to here. So Mason, what sort of situation and what sort of client would you typically suggest using asset-based finance for it? And what would be the advantages for them?
Okay. I mean, typical situations that I see is that lend itself to financing the debtor book is really where there's protracted payment terms that really stretch a company's working capital cycle. For any business considering using this type of facility, sales have to be business to business and invoices raised in arrears. The sales also need to be verifiable from an audit perspective for the asset-based lender to get their level of comfort that they need. This works, I guess if you draw a sort of scale, it works especially well for the recruitment industry, manufacturing industries where there's a strong audit trail for the sale, timesheets in the case of the recruitment industry, and a finished product, tangible finished product with a manufacturing business. At the other end of that scale, this type of funding I don't think would be appropriate, and you wouldn't be able to raise funds for where there is complexity to the invoicing process, such as in the construction industry or software development companies, where it's not so easy to establish the stage of completion, or there can be subjectivity involved with determining the actual value of the sale. Asset-based lending solutions are appropriate in quite varied scenarios. I've seen it used a lot for growing businesses that require finance for expansion, using the cash that is tied up in debtors once that's unlocked to use for investment for the business going forward. The advantage of this type of lending, which I will allude to a bit more later on as well, is that it's flexible. As the sales line grows, more cash is available from the facility to fund further growth. Businesses that require funding for an acquisition or MBO, MBI, that acquisition consideration can be financed by gearing the assets using an ABL structure that the company owns.
Okay, thanks, Mason. So the theory sounds good. So how about the reality? How does this work in practice? You mentioned earlier that you had a couple of case studies that you could share with us.
Yes, it's always nice to be able to talk about good news stories about our clients, really. The most recent sort of finance raising that I was involved with was for one of our clients where we recently assisted them to secure a £500,000 confidential invoice discounting facility. Just by way of background, the business was importing goods from overseas, selling to supermarket chains across the UK. The company had initially received startup capital of about £1 million by the founding directors, which had been utilised on product development and initial working capital requirements. Company had developed actually a very successful product, and there was exponential growth in sales. The business, they wanted to expand further, but just the demands on the business cash flow were becoming more acute. The client at that stage was unable to invest any further personal funds and wasn't keen to take on an overdraft facility. The overseas suppliers were requiring payment up front or on delivery with a 5-week delivery time, and the supermarket payment terms, which I'm sure our listeners are probably aware of, are quite stretched to 45 or 60 days after delivery. The company also had to fund the stock levels that they needed, which and to maintain that was 2 months' worth of stock in its UK warehouse. We felt that the traditional forms of funding, such as an overdraft, were just not flexible enough to deal with the nature of the business. We actually suggested a confidential invoice discounting facility to our client as a more appropriate solution given the current stage of their growth, and approached an asset-based lender that we had developed a relationship with over many years. We knew that they'd provide our client with an efficient and a professional service. We needed a quick response, as further delays would have only hampered the client's business further. The whole process from initial introduction to the asset-based lender and the facility actually going live was concluded within 8 weeks, but this was also over the Christmas holiday period as well, so I think you can pull out about 3 weeks from that time frame as well. great outcome for the client. They received an advance of 65% of their age debt book, and the concentration levels on that were set at 50%. And the funding they received significantly improved the cash flow position of the business and provided the additional working capital that they needed to expand the business further. Good news, turnover has more than doubled over last year, and the client is extremely happy with how the facility is operating. I just think being able to assist our client has significantly strengthened the relationship with them. Similarly, we also act for a very successful recruitment business, which had a few cash flow problems, mainly as a consequence of a significant investment on technology for a new area of their business for an automated software platform. That investment was actually paid out of the current cash flow of the business, so it was causing problems. So the actual asset-based lending solution was to refinance the existing lender with a more aggressive prepayment, so it was increased from 85% to 90%. And there was also a part of that invoice discounting package. There was an additional £500,000 cash flow loan injected into the business to deal with the financing of that historical IT cost, and that loan was taken out over 3 years going forward. The way the actual lending solution was packaged by bringing in more than one aspect of financing on the balance sheet, it significantly assisted our client in overcoming their short-term cash flow issue due to investing for the future growth. So two really successful stories that we've used asset-based lending for.
Okay, well, it's great to hear those good stories, and obviously great for you to get happy clients. So, and I'm sure that's what all accountancy practices aim for. So, lots of good stories, but obviously asset-based lending is just one form of business financing for growing businesses. I think now maybe if we go back to slide 24, we can just have a look. The one after this, slide 24, we can have a look at just other for traditional lending. So with the patterns of other kinds of lending, what are the cons of asset-based finance compared to other forms?
I mean, there's a number of different ways businesses go about funding their business. I won't touch on equity type investment at this stage because I want to compare apples with apples really and focus on the advantages and disadvantages of other methods of debt financing, which mainly includes the traditional bank overdraft or loans, bank loans or loans such as the Enterprise Finance Guarantee Loan Scheme. Factoring and invoice discounting, as I've mentioned previously, are an extremely flexible form of finance. The facility can rise and fall as your need dictates. If a company is under pressure and sales are growing, it really is a vital tool. Security for these types of facilities are taken over the assets of the business, so generally it would be unusual for directors to have to provide personal guarantees to support the funding as it is being secured on the assets of the business. I think the disadvantages for certain businesses is if they do have a concentration of debtors which can cause difficulties, and it can be perceived as being expensive. This flexibility does have a price, and with any debt-based product, I would always try and negotiate as favourable rate as possible for our clients with the lender involved. Asset refinance, it's a quick method, although raising this finance this way is never cheap. The value of assets is established by the asset-based lender, so it's probably never as much as the client expects. So it's all about managing expectations as well. I guess advantages of bank overdraft decisions can be usually quick if you've got good information to give to your bank. If you've got a historically good relationship with your bank, then hopefully they won't want to lose you as a client and hopefully give you some assistance that you need. But then the bank would generally, if you're increasing the facility that you need, would generally want more security from the company and its directors, and that could be personal guarantees as well by the directors.
Okay, well, thanks, Mason. So now let's turn to what all this means for you and your colleagues. In practice, what are the advantages for you and accountants providing services for their clients in doing this sort of thing?
I guess whenever companies require finance or there is a working capital cash flow issue, there's an immense pressure on the business. There's pressure on the owners of the business. So it's a stressful time for business owners, especially if their banks are not being helpful, which can often be the case, particularly over the last recession, the last 5 or 6 years. Being able to assist clients when cash flow is an issue and understanding how to help, what the potential solutions are, I think gives us a more competitive edge to the services we provide to our clients, and where I believe clients perceive they're getting added value from Silver Levene. I have tried over the years to develop a network of contacts with third-party trusted advisors that I have confidence in being able to introduce clients to. For me, a trusted advisor reflects the same level of professionalism and duty of care to our clients as we would ourselves as accountants to our clients.
Okay, Mason, and a sort of obvious question, how do you price these services to your clients?
Our fees are normally structured on a percentage of the funds successfully raised for clients, and it would vary depending on the complexity of the package of funding that they're looking to secure and the level of funding that they require as well. But obviously it needs to be value for money for the client as well.
Okay, well, thanks for that, Mason. We're coming to the end of our time for this section, so just one last quick question. I'm going to ask you to gaze into your crystal ball. Where do you see asset-based lending going in the future, both in terms of something you would recommend to your own clients and in terms of the wider market?
Chris, I wish I did have a crystal ball. I definitely know which numbers to pick for the Euro Millions draw this week. In all seriousness, with current trends in the market, I'd be surprised to see a reversal back to more traditional base lending. The asset-based lending industry has significantly improved its practices over the years. They've really come to the forefront over the last recession, where there's been constraints on banks and how they've treated the clients that are applying for loans and overdrafts. So I think that's where this growth in asset-based lending and where the new forms of funding have come in as well, where more assets on the balance sheet are being looked at, unlocking more cash. So I can only see this aspect of financing growing probably at the rate that it is. The fact that obviously the economy is improving, the green shoots are there, businesses are looking for finance for growth, and this is how to tackle that issue, really.
Okay, well, thanks very much, Mason. Many thanks for sharing the benefit of your clearly wide experience in this area and for sharing some of your stories with clients. I'm sure that you've given everyone listening today lots of food for thought. So it's nearly the end of the webinar, but it's not quite over yet. We've still got 10 minutes or so for the question and answer session. It's not too late to email in your questions. So while we do that, let's have a look at some of the questions that have come in so far. So just to give Mason a chance to have a look at the inbox of questions, we're going to start with May and have a look at some of the questions that have come in. So May, quite a specific technical question. What are the new proposed small company limits?
Yeah, I mentioned turnover in my presentation earlier. I forgot to mention the balance sheet total. So BIS are basically proposing to go for the maximum limits that the accounting directive will permit. So turnover, they're proposing at 10.2 million. Balance sheet total of 5.1, which is going up from 3.36 million currently. And the number of employees is staying at 50.
Okay, thanks, May. Let's turn to another one. So still on these sort of requirements, what are the minimum disclosure requirements for micro entities and small companies?
For micro entities, I don't think I actually went into the detail, but the regime at the moment basically only requires micros to make 2 disclosures, and it's around kind of commitments in terms of their finances and a little bit in terms of their directors. So there are actually only 2 disclosure requirements that we can mandate per the legal regulations on micros. In terms of the small, the EU directive basically allows 8 mandatory disclosure requirements that member states have to allow. So they include the fixed asset revaluation table, a note about fair value, financial commitments, guarantees and contingencies that are not included on the balance sheet, advances and credits made on behalf of directors, any exceptional items, amounts due or payable after 5 years, and also the average number of employees. So those are the ones that are mandatory, and then there are 5 member state options. BIS are proposing to take all 5 options as part of their consultation, and the 5 optional disclosure notes are the fixed asset notes on top of the fixed asset revaluation table, name and registered offices, the nature and business purpose of the arrangements not included in the balance sheet, nature and effect of post-balance sheet events, and also some related party transactions. So you can see that the mandatory and the optional disclosure package under the accounting directive is significantly lower compared to what the disclosures are in the current regime.
Okay, well, thanks for that, May. Thanks for giving that detail there. So another question, slightly different tack this one. What framework should small charities or small charitable companies use?
I mentioned in my presentation that charities aren't permitted to use the micros regime. So if they are a small charitable company, they are a small company, so they would use the small company regime, just that they can't opt to go into the micro regime.
Okay, well, thank you for that. A bit of a more sort of thematic question here, and a bit of a journalistic one as well. What are the most common questions you're getting about these changes? What causes the most confusion and fuss?
The most fuss has been what's going on with the frizzy. A lot of people either didn't realise that we're proposing to get rid of it, or they've heard that we're getting rid of it, but they don't understand why we're getting rid of it, because there's a lot of people who love the frizzy out there. But there are genuine reasons why we need to, simply because it just won't comply with the legal requirements once the new accounting directive comes in. So that's probably the biggest thing we're getting asked questions about, and obviously we need people's feedback as to whether they think it's a good idea, if we should potentially do something different, if you like what we're proposing. So again, I would really encourage you to try and respond to our consultation. Okay, well, thanks very much, May. Thank you for that. We might have time for one more at the end, but let's turn to Mason now. And so we've just got to rearrange ourselves. So, Mason, you talked about, you gave us a couple of case studies of where things had gone well, and certainly you mentioned that the clients were very happy with what they got. Is that typical? Do you get much feedback from clients once these these arrangements are up and running, once they've already taken advantage, and are people generally pleased with the result?
The clients that we've acted for over the years, where we have put these finance packages or assisted in getting those finance packages put in place, are extremely happy with the results. It is an ongoing process. I wouldn't just recommend or advise a course of action, get the funding in place and then sort of just leave the clients to get on with it. We want to know that they're happy with the service and how the facility is being run by the asset-based lender. Some of them can do quite a good sales job initially, but it's actually how the facility runs once it's implemented is key to the efficient running of the business, and how the funds are drawn down on a monthly basis as well, or when they need them. We're also involved with looking at our clients' financial accounts, management accounts on a fairly regular basis, so we can see what's actually going on, and there will be times when clients will want to renew these facilities as well. So we'll want to be involved at that stage as well. But I haven't had any issues with any clients having problems once the facilities are put in place.
Okay, well, that actually rather neatly segues onto another question that we've had. So just looking at the business itself, what things does it have to have in place to make a success of it, to successfully use this kind of finance?
I think it really comes down to the accounting function, really, of the business and the reporting function. Once the facilities are put in place, there is an onus on businesses to actually have to provide accurate accounting information on a timely basis to the asset-based lenders. So that process needs to either be put in place just prior to getting the funding, and it needs to be robust going forward effectively. So there is more of an onus on clients to produce more, probably more periodic, more regular accounting information than they may have historically been used to.
Okay, and then just kind of turning to your fellow practitioners, I mean, if a firm of accountants is going to offer advice in this area, I'm sure many do, but there may be some who are moving into this kind of area. How would you sort of advise them to equip themselves to offer help in this area?
Well, I think it's having personal relationships with individuals at the asset-based lending teams effectively, and really it's not just I guess the initial sales team that you'd want to really have relationships with. It is with the actual teams that run the facilities once they're put in place. So you know that once that facility is up and running, that your clients are going to be happy. There's nothing worse than recommending a course of action to a client, not knowing really how well the asset-based lender is likely to perform, and then for an asset-based lender to come in and not perform, then that would be an absolute disaster. It's never happened to me, but so it's really going out there, meeting asset-based lenders, and it's not just a one-off meeting. It's really developing those relationships over time.
Okay, well, thanks, Mason. Well, we've running out of time, and that seems like a good point to wrap things up. So I need to bring things to a close. So I hope you found today's webinar useful. Apologies to those whose questions we haven't managed to get to. Everyone who registered for this webinar will be getting an email tomorrow with details of how they can listen to it again. It will be available for 3 months. So please do feel free to pass these details on to any colleagues or contacts who you think might find it useful. It only remains for me to say thank you very much to May Ashelford from the Financial Reporting Council, to Mason Bloom from Silver Levene, and to ABN AMRO Commercial Finance for its sponsorship and support of this event. And to all of you who've taken time to join us today, thank you and goodbye.